So welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. In front of your screens, you have EURUSD's daily chart. We're going to be mixing technicals with fundamentals today. Please remind you that all charts to be presented are to be of the same time frame unless otherwise stated. Now, starting with EURUSD, it seems to have hit a floor at 1.06. Let's make some small readjustments here so it becomes all a little bit more visible. Readjusting support and resistance lines, the labels at first. Now with EURUSD, I would be noting we could lower this a little bit. See how there is a support line here and resistance level at the same point. So that tends to drive us to 1.0690. I would be adjusting a little bit higher also the second support line at 1.0515. And moving to the final support line, is 3 at 1.0445. I would also be narrowing a little bit the first support line, the second resistance line. Note how it has provided resistance here, but also support here and here. One that would be the 1.0760. Let's have a look also at the final resistance level, which seems to be pretty valid, given that it has provided resistance here. I would be setting another resistance line here. And we may be having here also a mid level, which would be placed somewhere here. However, that remains to be seen. Okay. That should more or less be set. Let's talk direction. Now we note that there have been continuous lower peaks and lower troughs. Yet the price action has confined itself within the boundary set of the 1.0690 and the 1.06. So we may be able to have a clearer view here in the 4-hour chart. Allow me to drill out. Here it is. You can see how the pair remains in a sideways motion between the R1 and the S1. So back to the daily chart. On the one hand, we have a bearish predisposition, and that's being highlighted practically by two factors. A, the RSI indicator remains pretty low. It's at 37, implying some bearish predisposition on behalf of the market. The second would be that we have all three moving averages. That would be the 20, the median of the Bollinger Bands, the 50, which is the green one, and the 100, which is the orange one, all pointing downwards. Also note how both the 20 moving average has dropped below the 50, the 50 has dropped below the 100. All of them are practically bearish crosses, implying a bearish movement or continuance of that. So for a bearish outlook, though, I would require the pair to drop, breach the 1.06, and start aiming for the 1.0515. On the flip side, should the bulls take over, I would require the pair to rise, breach the 1.0690, and in that case, I would require a clear breach of the 20 moving average, the median of the Bollinger Band, in an effort to start aiming for 1.0760. I know it's still a way off, and that's why we tend to maintain primarily a bias for the sideways motion to continue initially, yet we issue also a warning about some bearish tendencies of the pair. Now, on a fundamental level, we tend to maintain the view that the US dollar remains the driver in the FX market. The US dollar may, on the one hand, weaken because there is an easing of safe haven inflows due to the relative easing of market worries about the Middle East. Nevertheless, the same worries tend to remain present, and that may lead to unexpected spikes. So I would be a little bit on the watch out for that. On the flip side, regarding the US dollar, we have also a big elephant in the room, and that's the inflation in the US, which tends to prove to be more sticky than expected. I wouldn't be surprised to see the Fed actually maintaining a more hawkish stance in its coming meeting on the 1st of May. Mind you that we have entered already a period at which Fed policymakers are not allowed to make any statements ahead of the meeting. So we may see analysts leading the way for the markets regarding the US dollar. Now, on the other hand, on the euro side of the pair, I would be noting the determination of ECB policymakers to start cutting rates in the June meeting, which is an issue. We had some comments of Bank of France Governor Galao, who practically stated that regardless of any uncertainty regarding oil prices, the bank must proceed with a rate cut or may proceed with a rate cut in its June meeting. I wouldn't be surprised to see also BUBA President Nagel mentioning similar comments. And I'm placing more weight on Nagel, not because Nagel is Germany's Bundesbank president. No, that's not the point. The point is that you could expect dovish comments from the Galau, but not from Nagel. Nagel used to be predominantly hawkish. So should even the hawk start indicating about a possible rate cut in the meeting, that could more currency. Other than that, in today's American session, we're getting from the Eurozone the consumer confidence. It's expected to remain in the negatives, yet improve a bit. And that could provide some support for the common currency. Okay, once again, base scenario for the time being is for the price action to remain sideways between the 1.0690 and the 1.06. It's a 90 pips corridor, which is quite well, while any bearish tendencies could emerge. So we should warning about that. Let's move now to USDJPY. Once again, the daily chart. The USDJPY, which is currently testing the 154.67, could go a little bit higher at 70. It's rounded up a little bit, actually even higher at 75. 80. Yeah. And allow me to verify this by drilling to the 1 hour chart. Could go a bit lower. Once again, 75. Too much. 80. 78. Correcting it. I would like to have a look also at the R2 though. Back to the daily chart. We have to go way, way back here. 34 years back. Back to the weekly chart. And daily. Seems to be valid. 1 hour maybe. Nope, does not allow us daily. Weekly, valid. Now the big question here is how valid these levels are. And I think the daily chart will be better to see. You see how it has provided resistance and support here. So there seems to be a level, as can be seen on the R3. But the question is, okay, after 34 years, how valid these levels are? It's a very, very interesting question. To tell you the truth, that's what we have to go with. For the time being, we tend to maintain the R1 as the key resistance line, which is actively providing resistance to the further upward movement of the pair. On the other hand, though, I would be noting that we have a clear-cut upward trend line, which tends to push the pair even higher. The RSI indicator is above the reading of 70, which on the one hand highlights the bullish sentiment of the market for the pair. On the flip side, though, I would be noting that it tends to imply that the pair is at overbought levels and maybe ripe for correction lower. Yet note how the price action has some distance with the upper Bollinger Band, which may allow the bull some room to play. At this point, it would be interesting to note also how the pair is moving in an upward channel. And allow me to draw that. There you go. Let's color this in blue. Crimson red. Yep. So you have an upward channel within which the price action is moving. That's pretty clear. And you have an upward trend line which is guiding the pair higher. You have the 20 moving average, the 100 and the 200 moving averages all pointing upwards, implying a bullish direction of the pair. More or less, that tends to allow us to be a little bit more optimistic that the bulls may hit new ground. In that case, we may see the price action breaching the 154.78 and start aiming for the 156.60. On the flip side, should the bear stick over, let's not forget we are talking about the daily chart here, I would expect the price action to drop, breach the pre-mentioned upward trend line, but I would also require a breach of 150 below the 152.70 support line. JPY seems to continue to weaken, and primarily that tends to be related also with BOJ's monetary policy, which despite a hike in the last meeting practically remains rather loose, in my opinion. And the outlook does not seem to be altering. However, that will be far more interesting to see on BOJ's interest rate decision release. That would be in Friday's Asian session, and should more or less the bank highlight the necessity for it to maintain a rather loose monetary policy, that could weigh on JPY. The big question here is, will the Japanese government actually intervene in the markets to support the JPY? Because you can see how the JPY is at very low levels against the US dollar already, in my opinion, dangerously low. But the question which arises, should the Japanese government intervene, is whether that will have any substantial impact, in the sense that, given that the fundamentals weakening the Japanese yen are still present, any market intervention by the Japanese government may prove to be practically short-lived, and that USDJPY may be allowed to move higher once again. So it's not just that the Japanese government can intervene. The question is of whether such an intervention will have any lasting effect. I think that's what's been making the Japanese government hesitate. Other than that, USDJPY has reached well within the range at which such an intervention could occur. So that's a small warning on the fundamental side, which could actually provide support for JPY and lower USDJPY below the S152.70. At that case, we may see it even breaching the 150.80. It's going to be burning lots and lots of long positions should that happen. Okay. Let's have a look also at USDCAD. Before that, allow me to drill into GBPUSD. Now, GBPUSD is the daily chart. You can see how the pair was already moving in a downward fashion, yet over the past few days, especially on Friday, had intensified its downward motion. And that's obvious still in today's Asian and early European session. So I tend to maintain a bearish outlook, given also that the RSI indicator has moved lower. Note that the 20 moving average has crossed the 50 and the 100 moving averages, which shows us an intensification of the bearish movement and may, in my opinion, be driving the pair lower. Should the bears maintain control, I would expect cable to breach the 1.2335 and start aiming for the 1.2180. On the flip side, should the pair stabilize, I would expect the price action to remain in the corridor set between the 1.2470, the R1, and the 1.2335, the first support line. While for a bullish outlook, I would require the pair to rise, breach the pre-mentioned downward trend line, breach the R1, breach the second downward trend line, and test the R2 1.2590. For the time being, though, such a scenario seems to be far-fetched. Okay, let's move now to USDCAD. There is an intense downward motion of USDCAD, and that's been ongoing for the past 4 days. Actually, today and the past 3 days, Friday, Thursday, Wednesday. That's pretty clear. It's characteristic how the pair has breached the S1 1.3775 and continued lower today to breach also the 1.3725, which is 50 pips lower. Now, for this pair, I'm going to be doing a total makeover. And when I'm saying this, I mean it, in the sense that it's quite questionable whether these tight support and resistance lines are going to be holding. Actually, they will not. And in this case, I'm going to be breaching deleting actually the first support line. Note how this pair has provided support here. That would be at the 1.3570. Also, the S1 has been broken, so that turns into a resistance line. In green. Let's recalibrate this. Moving now to the first resistance line, now being placed at 1.3725. Now you can see how, in contrast to any other pair we have seen so far, that would be the EURUSD, USDJPY, and GBPUSD, which have remained stable. We have intense mobility for USDCAD, and that's towards the Canadian dollar strengthening rather than anything else. Now, there are two main drivers for the Canadian dollar. The one would be an improved market sentiment. Why? Because the Canadian dollar is considered to be a risky asset, given that it's a commodity currency. And any improvement of the market sentiment tends to provide fundamental support for the Canadian dollar. The second factor I would be highlighting here would be the path of oil prices. And it's interesting to see whether oil prices have been on the rise. And if that's the case, it's understandable how it could provide some support for the CAD, given that Canada is a major oil producing country, and thus the market tends to maintain the view that there is a positive correlation between oil prices and the Canadian dollar, loonie. So the market expects that whenever we see oil prices rising, the Canadian economy is going to be earning more, and that tends to provide support also for the loonie. Let's have a look at oil prices. Has been on rise today. There's lots of volatility, however, there's downward motion. So definitely it's not WTI's price which is driving the Canadian dollar stronger. Most probably it will be the market sentiment which tends to be improving given the easing of wars about Gaza. Okay. For the time being, we tend to maintain a bearish outlook. I wouldn't be surprised to see the pair aiming for the 1.36 support line. Also note the RSI indicator, which is dropping, more or less started to aim for the reading of 50. That tends to highlight the easing of the bullish sentiment. And should the price action of the RSI indicator breach below the reading of 50, starting to aim for the reading of 30, that would be a clear indication that the bears have taken over. Mind you that the pair's RSI indicator in the daily chart hasn't been below the reading of 50, substantially below the reading of 50, since the beginning of the year, almost 10th of January. There were some breaks below it, but they were always temporary. Okay, let's have a look at the Aussie. And a similar factor, let's drill into the daily chart. You see the Aussie gaining some support today, but overall the movement remains sideways. And at this point, allow me to widen a little bit the support line, the S1, to the downside. Let's reposition the labels. Could go even lower. But I think this was more of a false break. Now the R3 remains unchanged. The R2 also. The R1 is clear in the sense that it has provided resistance here, support here, and here. So that's pretty valid, and that's the 0.6455. The S1 is being set at 0.6390. The S2 at 0.6285 remains, and the S3 at 0.6190. For the time being, we tend to maintain bias for the sideways motion to continue. It could go either way. Despite the RSI indicator being below the reading of 50, implying some bearish sentiment residue within the market. Now, should the bulls take over, I would expect the price action of AUD/USD to breach the R1 0.6455 and start aiming for the R2 0.6545. On the flip side, the bears being charged, I would expect the price action of AUD/USD to breach the S1 0.6390 clearly and start aiming for the S2 0.6285. Now, I would be highlighting for Aussie traders practically 3 factors to watch out for this week. Definitely the first would be the release of Australia's CPI rates. A possible slowdown of the CPI rates on a quarter one could more or less also turn RBA more dovish. Albeit we have to note that the CPI rates are still a long way off before meeting or entering RBA's inflation target zone. So that's a big issue. At the same time, I would be also noting the importance of the market sentiment. The Aussie is considered to be of risk in nature. So whenever we see a more risk-oriented market approach, that could provide support for the Aussie and vice versa. And the last factor I would be noting would be China. Should we see an improvement of China's data or any hints that practically economic recovery in China is being expedited, that could provide support for the Aussie, given that Australia exports a high amount of raw materials towards China. And that's of importance for the Aussie traders as well. Let's have a look now beyond the FX market. I'd like to see oil prices, which we have mentioned before. Now, the interesting part here is that the upward trend line has been broken. And we are always in the daily chart. That's clear. Allow me to reposition the labels so we have a better viewing. Now, I think we have the downward motion is clear. We can also, not just yet, but I wouldn't be surprised to see a downward trend line starting to form here. And in that case, we may be talking about something like this. However, that's not quite representative just yet. Actually, the downward motion has been expedited here, and we're setting the 80.35 as the commodity price target. Note it was aimed for during today's Asian session. It has provided support a number of times here. So for a bearish outlook to be maintained, the S1 has to be breached, and in that case, the next possible target for the bears would be set at 78.20. On the fundamental level, I would note that the easing of market risks for the Middle East may have a weight on WTI's price, and you can see how the price action has started to fall about 5 days ago. I would be noting also the possible slack in the US oil market, which could be providing additional bearish tendencies for the commodities price, in which case we may see WTI's price dropping below the S1 once again. I would be noting here that we have AP's weekly crude oil inventories figure due tomorrow in the late American session. Should we see a wider a wider increase of oil reserves, as already mentioned, that was of 4.09 million barrels last week. So should we see an increase of oil inventories beyond that, that could more or less provide additional bearish tendencies for WTI's price. Okay, let's have a look at EURUSD. That would be gold's price. Let's look at the daily chart. It feels as if we need some readjustments here. The support and resistance lines, in my opinion, are now too tight. I think we have surpassed most of the record high levels. Yep. Back to the daily chart. Now we're setting the resistance line at 2,430, which is a record high level for the precious metal. Higher than that, we're setting as possible boundaries the 2,500 and the 2,550. It's possible target for the bulls, looking everything in. And let's discuss the support lines, starting with the 2,360, 2,305, which used to be a resistance line out into support, and the 2,228, also form a resistance line out. The sideways motion of the pair is present. On the other hand, though, those are the bearish tendencies of the price action of the precious metal. The RSI indicator has reached below the reading of 70. That's for the first time since the start of the month, implying more or less that the bullish sentiment may be fading away here. Should we see an intensification of the bearish movement, we may see the price action breaching the S1 2260 and starting to aim for the 2,305. At this point, I would be setting another support line down here. I know it's way off, but we may see increased volatility. 2,150 being set as the support practically. And should the bears actually gain control, that would allow us also to start drawing a downward trend line showing us the limitations of the downward movement. Let's go now to use stock markets, and I'm starting with NASDAQ. The S1 has to be turned into a resistance line. Let's go hunting for a new ultimate support level, like here. Green. Okay, let's correct also the labels. Starting with the R3, which is now placed at 41,000. R2 at 40,000, which is also record high practically. It was just a bit higher. $39,140 being the one. S1 being set at 38,000. S2 being set at 37,100. And the S3 at 35,950. Now let's talk direction. Definitely the downward motion has been breached, and that's been signaled practically. You can see how the downward motion, which was characterized by a downward trend, having 1, 2, 3 lower peaks and 1, 2, 3 lower truths, has been breached today. Should that be maintained with a possible stabilization of the index or even movement higher, that would, on a technical basis, highlight the interruption of the downward motion. Also note how the RSI indicator is on the rise, aiming for the reading of 50, which on the one hand tends to highlight how the bearish sentiment is fading away. At the same time, there seems to be some degree of uncertainty about the future outlook of the index, or the market sentiment if you prefer. On a fundamental level, I would be noting definitely after the US inflation and the Fed's intentions and the overall easing of uncertainty regarding the Middle East, setting those two apart on the slide, I would highlight the earnings reports throughout this week. We intend to focus primarily on the tech sector. We're getting a number of releases relating to the sector. And I wouldn't be surprised to see also NASDAQ getting increased volatility over the next few days up until the end. So at that point, allow me first to conclude with the Dow Jones, and then we have a quick look at NASDAQ as well. Once again, direction for the time being, USD US 30, which is Dow Jones 30, seems to have interrupted its downward motion. For the time being, we switch our bearish outlook in favor of a sideways movement bias, and would require the pair to start decisively aiming, if not breach, the R1 in order for us to actually reverse that into a bullish outlook. NASDAQ, on the other hand, had similar movements, but it was far more intense, and for the time being, the bearish movement seems to be still present. It's a very, very tight downward motion. Okay, let's drill out. It's interesting how it has found support all the way down here. And I'm citing this, I'm correcting the support line for two reasons. A, that was yesterday's low, but it has also provided resistance back here, so that's a pretty valid level. Also, the first resistance line could go a little bit higher. Okay. Let's correct also the labels. 18,490 is practically a record high. Could go, if I'm correct, also at 18,500. Let's have a look. Yep. It wasn't touched as such, but it came pretty near. Let's set also the S2 at 68,985. Could go 80, could go 50. And final support line being set at 16,165. That remains unchanged. I'm going to be lowering, though, the support line, the second resistance line, given that the volatility of the pair to the upside was weakened. There you go. Let's correct the labels as well. Starting with the R3 at 20,000. $19,300. $18,500. That has been breached, has to be changed into resistance line. Let's set the new S3. I'm setting it on this peak here. However, I need more peak to be this one. Green. Widening it. Starting with the S3 now at 15,540. S2 at 16,165. S1 at 16,960. R1 at 17,800. R2 at 18,500. And R3 at 19,300. Allow me also to drill into the 1 hour chart. I would require more detail here. Back to the daily chart. That's better. So we tend to maintain a bearish outlook. And I would be noting that. Why? Because we have a clear-cut downward trend line leading the pair lower, which remains intact. Also note how the Bollinger Bands have dropped. Also note how the RSI indicator below our daily chart remains near the reading of 30 despite actually bouncing on it. Now, the fact that the price action has breached below the low Bollinger Band may actually cause the pair to correct higher, possibly shifting the downward trend line a little bit to the right, yet overall the bearish outlook seems to remain present. And should the bet in control over NASDAQ, I would expect it to breach the 16,960 and start aiming for the 16,165. I know it would take more than a day to reach any of the levels, but I tend to prefer to keep them wide, given that we saw some wide volatility during Friday's session. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
If you've just joined, we're going to be talking about how you can set up your training journal and a couple of important pointers as well. So before we get started, as per usual, a risk warning: our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suited for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. Redistribution. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We're gonna talk about how you can get the most out of your MyFX book. We're gonna talk about optimizing your strategy. So what's the best days, best times, best techniques as well. And also we'll be talking about the best direction. So how exactly you can do a bit of trend trading. Okay, let's get started. So what exactly is a trading journal? So it's basically like a diary, and it's a way for you to track your trading performance by recording all of your trades. So you can start a manual or an Excel sheet, or an automated trade journal, and I'll show you guys some examples in a little bit. So, importance of a trade journal. So before we dive into the specifics, let's quickly touch on why exactly having a trade journal is crucial. So trading journals, as we mentioned earlier, serves as your personal trading diary. So it helps you to track your trades, analyze your performance, and ultimately improve your results over time. So some points on why exactly you should start using a trading journal. Firstly, is to track your progress. So it basically provides insights into your performance and helps you to identify patterns in your trades. This also helps you to learn from your mistakes because you're recording your trades and understanding the reasoning behind them so that you can learn from your mistakes, avoid repeating them in the future. Okay, so this self-reflection is crucial for continuous improvement as a trader. Next is to develop discipline. So maintaining a trading journal instills discipline in your trading approach because it encourages you to stick to your trading plan and avoid impulsive decisions by holding yourself accountable for your actions. So I'm sure if any of you guys have ever traded, you will know how difficult it is to really maintain and stick to your trading plan, especially when it's not going according to your plan. Okay, so next, evaluate strategies. So you can identify which strategies are working well and which ones need adjustment or refinement. So this helps you to basically evaluate the effectiveness of your trading strategies. Manage emotions. So emotions can significantly impact trading decisions. So as I mentioned earlier, when a trade doesn't go according to your plan, having a trading journal basically helps you to manage those impulsive emotions by providing a structured way to review your trades in an objective manner so that it reduces the influence of fear or greed on your trading decisions. So this also helps you to set realistic goals and track your goals so that you can stay focused and motivated. Improve decision making. We kind of talked about this already. Enhance accountability. So when you're keeping a trading journal, it encourages transparency and honesty with yourself about your performance, fostering a culture of responsibility in your trading approach. Okay, so let's look at MyFX book. So MyFX book is a powerful tool for tracking, analyzing, and sharing your trading results. So from setting up your account to utilizing advanced features, we'll talk a bit about how to leverage MyFX book to its fullest potential. Okay, so let's start off with what should you monitor in your journal. So typically, a trading journal should include the date and time of your trade, basically the open as well as close, the instrument being traded, so whether it's dollar yen, euro dollar, gold, WTI. position size, yeah, and then direction, whether you're going in for a buy or a sell, entry and exit points, trade result once your position is closed, profit and loss at an absolute level as a percentage of the account size, and your risk and reward. So how can your journal improve your trading? So we briefly talked about this earlier, but basically, since you are able to review your trading activity over various timeframes, so daily, weekly, or monthly, it will allow you to find the right trading style, whether you are a swing trader, position trader, intraday, or scalper, and identify your strengths and weaknesses, improve your risk management, as well as have discipline. Okay, so how do you set up your trading journal? Basically, you first have to choose a format, decide on what categories you're going to be trading, followed by capturing trade details, analyze trade performance, reflect on the emotional factors, review and adapt, and maintain discipline. Okay, so these are some of the skills that you will be developing when you set up your trading journal. Performance analysis, learning and development, emotional awareness, risk management, trade planning and execution, accountability and discipline, and confidence building. Okay, so let's talk about these examples really quickly. Okay, so there are a couple of examples that we've included here about how to create a Forex trading journal. So this example is in Excel. So by using an Excel spreadsheet, this example over here, so all of these are automated. So this one is manual because obviously you have to type in the data yourself, as you can see in this example here. Okay, but yeah, so this will basically look like, this is what your spreadsheet should look like. With the initial, maximum, the date, the profit and loss. Yeah. Okay. Yeah, and then for automated tradings, you can read this website as well. Okay, there are some which are free and some that you have to pay for. Okay, so the manual option is obviously free since you have to set up the table yourself. So it's really up to you and your own trading strategy. Okay, so you can go ahead and take a look at these two websites. Yeah, I'll go ahead and pop these two websites in the chat as well. So the one that I'm popping into the chat now is the manual one. Okay, and then the automated one is over here. So I won't go too in-depth into how to set up your automated trading journal because I think if you go into the website, it will tell you exactly how to do it. So yeah, let's just move on. You can also look at Forex Book. Okay, yeah, so these are just some of our recommendations. Of course, it's completely up to you and your objectives when you're deciding which of these to choose from. But yeah, these are just some of our suggestions. Okay. Okay, let's move on. So let's talk a bit about optimizing your strategy. So a trading journal is not just about recording your trades, but also about analyzing them to identify patterns and areas for improvement. So let's talk a bit about some strategies for analyzing your trades and refining your approach for better results. So firstly, let's let's start off by talking about the best times to trade. So market volatility happens throughout the week and it varies. So we're going to talk about which days tend to have higher volatility and better trading opportunities. And we're also going to introduce economic calendars and how you can utilize them to identify when market volatility is the highest. Okay, so let's look at what exactly is an FX news calendar. So firstly, on the left, over here, we have investing.com. And on the right is forexfactory.com, which is the one that I typically prefer to use. Yeah, but they're basically about the same. They give you the dates that you're looking for. You can filter the dates. So if you're looking at this week's economic data releases, you can just filter it to look at this week or this month. And then as you can see from these little colored calendars, it also filters by low to high impact events. And it gives you the forecasted values, the previous values, as well as the actual values once the data is released. Okay, so these FX news calendars are important because it allows you to see at one glance all of the important economic data releases. And these data releases often create more volatility in the markets. So it's important to take note of them. So it shows you the key events such as the GDP, CPI, NFP, crude oil inventories, and even central banks' monetary policy meetings. Okay, so let's understand some high impact events. Firstly, we are looking at the US. So FOMC meetings are the Federal Open Market Committee, and this is the US Fed's way of communicating their view on monetary policies. So these normally come together with a Fed interest rate decision. So if the Fed is dovish, the USD is bearish, and if the Fed is hawkish, the USD is bullish. If interest rate goes up, the USD is bullish, and if interest rate goes down, the USD is bearish. Okay, next we have NFP, or non-farm payroll, which measures the change in citizens that are employed from the previous month, excluding the farming industry. Unemployment rate measures the total unemployment of workforce that is seeking active employment from the previous month. Okay, and now crude oil inventory. So these measure the weekly change in the amount of crude held by US firms. So if crude inventories increase, they are inversely related to oil prices, so we can expect oil prices to drop. EIA is Energy Information Admin, and this is a short-term outlook. So it's basically the monthly forecast for the year ahead, the demand and prices across major fuel types. Okay, so some benefits of using the FX calendar. Depending on your individual trading style, it can help to plan trades and allocations for the day, week, or month ahead. And it also helps to alert the individual to upcoming important news events that may affect volatility. Let me know if you guys have any questions so far. Okay, if there are no questions, let's move on. Okay, so now we are getting into kind of the fun part. We're gonna talk about some of our favorite techniques, or just some techniques that you should maybe take note of. Firstly, of course, I'm just gonna touch really quickly on this because we recently finished our Fibonacci series. So if you missed that, I think it's probably uploaded on YouTube, but if not, you can email IronFX on their website and they will probably send you the recording or give you the link. Yeah. So I'm just going to briefly talk about the checklist and what things you should look out for. Okay. So for Fibonacci, there are a couple of steps. Firstly, is the market structure clear? So you want to look for big zigzags, and we want to see, a very clear market structure, so clear up or down. Okay, yeah. So next, identify the recent trend. So are prices going down or up? So it's important to always follow the general trend. Next is to identify recent major swing lows and recent major swing highs. And lastly, connect the two extreme points from the highest to lowest for a downtrend and the lowest to highest for an uptrend. Okay, so let's move on. Next, which is quite important, is your take profit and stop loss levels. Okay, so for your take profit and stop loss levels, it's important to place your stop loss beyond a key confluence level, or if you look here, a key major resistance level. So in this case, we are going in for a sell since our take profit is below. So since we're going in for a sell, we will place our take profit before any levels. So in this case, it will be above any major support level. And for stop loss, we will place it beyond any major resistance level. So in this case, we're placing it above. Okay, so the reason for this is because price is attracted to such strong areas of Fibonacci confluence, or even if it's just multiple swing high levels that line up in the same area, that's also a major resistance area. So price is attracted to these areas. So if your stop loss is right before these areas instead of beyond it, you will most likely get stopped out before the market reverses. So like you can see over here, we would most likely get stopped out if we had placed the stop loss slightly below. Okay, for take profit, we typically recommend to place your take profit before a key Fibonacci confluence area, because when price reaches any significant area, there is a high chance that it won't be able to go beyond it. So instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. And this is one of the reasons why people complain that the market is being manipulated, because they might miss that take profit by 1 or 2 pips. Okay? So now let's talk about another technique, which is the trailing stop loss. So in our previous slide, we talked about, we go back. So this is kind of a fixed stop loss template. So if we talk about trailing stop loss, it's a type of stop loss that is set at a certain percentage or dollar amount away from the market price. So the idea behind a trailing stop loss is to lock in profits while giving the trade room to breathe. So basically, it means that the stop loss basically follows the market price as it moves in favor of the trade. So the example I have here is, we're talking about stocks, but the idea is pretty similar if we're talking about currency. So let's say you buy a stock at $100 and you set a trailing stop loss at $10. As the stock price rises to 110, the stop loss will follow, now at $100, since 110 minus $10. So if the stock price drops to $100, your stop loss will trigger, selling your position and protecting your profits. The trailing stop loss technique can be useful for traders because it allows them to manage risk and lock in profits dynamically as the market moves. So this is different from a fixed stop loss, which is set at a specific price and does not change as the market moves. So it's important to note that a strict trailing stop loss is not a guarantee that you will exit the trade at the desired price. Market conditions such as gaps or rapid price movements can trigger a stop loss order before it reaches the desired level, leading to an unexpected exit from the trade. Therefore, it's important to use trading stop loss in combination with a solid risk management strategy. Okay, I just realized I didn't show you guys the FX news calendar that we like to use. So let me do that now. Okay, so earlier I talked about Forex Factory being one of the FX news calendars that we like to use. So if you click on the date, so when you go into the page, it looks like this. And clicking on the date, you can select this week, apply settings, and you get the whole list of news events for this week. So if you click on this green icon, you can see that I've filtered it to only the high and medium impact events. But you can select all, you can filter out the currencies that you're looking at and the different event types, apply filter. And yeah, you can see once the actual result is released, it will update. But it will also give you the forecasted values, predicted values, forecasted as well as previous values, and the currencies as well as the different times. Okay. Also, if you weren't here for the Fibonacci webinars, you can also go onto forexalchemy.com over here. Okay, and you can click on trading guides. How to draw Fibonacci retracement correctly, and it gives you a pretty in-depth explanation on how to draw Fibonacci's. So we have a couple of videos for you to watch as well. What to look out for, unclear and clear market structures. Yeah, what to look out for, checklist. Yeah. So there are also different techniques for Fibonacci. So we're going, I think in this guide, we go through each of them. So we have retracement up above there, as well as the different other Fibonacci techniques. So here we are combining them in order to find Fibonacci confluence levels. Yep, so feel free to go ahead and take a look. Okay, let's get back to my slides. Okay, so let's look at the different methods of trading stop loss. So here's a summary of the different types of trading stop loss methods that we'll be going through today. Just really briefly, firstly is the moving average indicator, followed by parabolic star, chandelier, ATR indicator, support and resistance levels, and a combination of these methods. Firstly, we'll start off with looking at the moving average. Okay, so you can see that using our MA, the trading stop loss is triggered when price basically breaks out of it and moves above the moving average. So I think that's pretty straightforward. You can see in this example as well that it got us out before price started to increase. If we look at a trend line breakout, okay, actually this line here is kind of a trend line breakout. The only issue why we can't call it a trend line breakout is because trend lines have to have a minimum of 3 touches in order to be considered valid. And you can see in this case, we only have 2, okay, before price broke out of the trend line. So when price breaks out the trend line, that's typically a sign that price is going to move in the opposite direction, which it did. So when it moved in this downtrend, so we went in for a sell entry, and then placing this trend line here, we got out when price breaks out of the descending trend line. I think that's pretty straightforward. So let's look at parabolic SAR. So kind of the same concept. Here you see when price moves below the parabolic SAR, it's typically giving us a bearish signal. So when price begins to move above the parabolic SAR, you can see that it's moving above it. It's even broken out of the top, the upper side of the indicator. Okay, so that's a sign that trend is going to change. Okay, chandelier and ATR, same concept as well. Price is moving below, giving us a bearish signal. Once price moves above or breaks above these indicators, then both of them are triggered and our stop loss, and we get out of the trade. So I think that's pretty straightforward because all of these concepts are pretty similar just by using different indicators so that you can kind of substantiate your analysis to show that, okay, price is really breaking out over here, the trend is really changing, so I should get out of the trade. Okay. In this example, so this is just another example. In this case, we have a fixed stop loss. You can see it's a fixed stop loss at the swing high. Our sell entry is here when price breaks below this line. And also, it's moving below our moving average. Here's our take profits over here. So you can see, instead of just leaving our stop loss here, which you can see is really far away from where price is currently at, by using a trailing stop loss, we can get out of the trade right when price breaks above this level here. Similarly, in this case, price is breaking out of this descending trend line. Stop loss is placed slightly above. Like we mentioned earlier, stop loss should be placed beyond, take profit should be placed before. So we're going in for a sell entry and going towards a take profit over here. Okay. Okay, now let's look at using breakouts as trailing stop loss. So breakouts are usually high volatility events, and price can spike up and reverse almost as quickly. So a stop loss will help you to manage risk, protect your capital, and a trailing stop loss can help you to protect your profit like we've seen in the previous slides. Okay, so let's move on to our next technique. Okay, trend trading. So here's a super simplified breakdown of how trend trading works. Firstly, you want to identify your trend. So in a price movement of a currency pair. So this is typically done by analyzing historical price charts, and an uptrend is characterized by higher highs and higher lows, while a downtrend is characterized by lower highs and lower lows. Okay, so entry points. Once you have identify a trend, the next step is to find an entry point. So in an uptrend, you might look to enter a trade when the price has retraced or pulled back slightly from its recent high. So basically, you're anticipating that the trend will continue. But in a downtrend, you might look for a retracement before the price continues its downward movement. So next we have setting stop loss and take profit levels. So to manage risk, it's crucial to set stop loss and take profit levels. So stop loss is a predetermined price at which your trade will automatically close to limit potential losses if the market moves against you. So a take profit level is where you decide to exit the trade to lock in profits before the trade potentially reverses. Number 4, riding the trend. So once you're in the trade and the trend continues, you aim to stay in the trade as long as the trend remains intact. So basically, in this situation, you would be monitoring the price movement and adjusting your stop loss and take profit levels if needed. Or you might choose to use a trailing stop loss that we just went through as well. Lastly, exiting the trade. So this typically happens when the trend reverses. But yeah, trends don't last forever, so it's important to be vigilant and not get too greedy. And remember to decide to exit your trade and take your profits where possible. Practice analysis. So I think that's pretty self-explanatory, so I won't get into that. Okay. So pullback support and resistance. So these are pretty basic trading knowledge, I suppose. But basically, a pullback support is a strong level of support which breaks out from a previous resistance level and price is now dropping back to visit it again. So pro tip is when a pullback support lines up with a Fibonacci level, it tends to be very powerful. Pullback resistance, on the other hand, works well when it breaks a significant swing low and then starts pulling back to it. Even better if there are multiple Fibonacci levels that line up with it. So here's an example. So you can see at the red area, price tested this level 3 times with multiple swing highs in line with one another. And once price breaks the red area, it becomes a pullback support level. Then we expect price to pull back or retrace this level, which you can see from the dotted arrows. And this is an example of a pullback resistance. So you can see once price breaks the level, it becomes a pullback resistance, and we expect price to retrace and pull back to the same level, like you can see from these red arrows. Okay, now pullback resistance. Here we have a swing low, and thus a possible support level. With price passing below the swing low support, it is now a pullback resistance. Okay, so if we see in the next slide, you can see that price actually pulls back to this resistance level. Yeah, and once it reaches and reverses off the pullback resistance level, it then becomes an overlap resistance level. Okay, which we will get into now. So overlap resistance occurs when price reacts off a particular level from the top and from the bottom. So the more times that it reacts off this area, the stronger the overlap area. This basically means that there are bulls and bears that are respecting that area, so it's important to take note of that. Okay, so here the pro tip is that if the overlap area lines up with other elements, such as Fibonacci or graphical elements, it will make it even stronger. So that's basically what we call the confluence areas. Yeah, that applies for any support and resistance level that you can find. If you can support it with your Fibonacci, your pivot points, your pivot point indicators, that would be even better. Okay, so here's an example. Basically, you can see how once price breaks below the support at 105.643, you can see how price retraced or pulled back to this resistance level and reversed off of it, making it now an overlap resistance. Okay, here's another example. So here we have a big swing high resistance level. Price surpasses this level and becomes a pullback support where we expect price to pull back to that level. So in the green areas over here, we see price retrace this level and actually bounce off perfectly. So once price bounces off the pullback support, it then becomes an overlap support. Okay, in our second example, we see two swing highs lining up. So we have a swing high resistance. So price has surpassed this level as well and making it a pullback support. Here we can expect price to retrace to that level. So you take note of the blue circles. Price bounces off this level twice, making it a strong overlap support. Okay. Okay. In this last example, we have multiple swing lows that are in line at the 33420 level. So once price breaks this level, it becomes a pullback resistance. We can see price has tested this level 3 times, 1, 2, 3 over here, making it a strong overlap resistance level. And then once price passes again, then it becomes a pullback support. And once it bounces off that level, it then becomes an overlap support. I think by now you guys have gotten it. So let's move on to our last technique. Okay, so how do you identify a trend? Okay, I briefly talked about this earlier. So how you can identify trends is obviously you can just look at the charts and you tend to be able to identify whether it's ascending or it's moving in a downtrend or whether it is ranging. But if you want to be extra certain, you can try looking for trend lines and trend channels. So what makes a valid trend line is if there are at least 3 significant touches. For an ascending trend line, the touches should be on the bottom and on, yeah, so if it's descending, then the touches should be at the top. So here's another example. Okay, you can see the touches on the bottom and here as well. For descending trend lines, it should be on the top and on the bottom, but same thing, we are looking for at least 3 significant touches. So you can see here, we have about 4, and here we have about 4 as well. Okay, so watch out for at least 3 significant touches for it to be considered a valid trend line, like over here. Okay, and you can see on the 4th touch, price is playing the reaction. Okay, so let me know if you guys think that this trend line is valid or not in the chat. Okay, someone said that it's not valid. Yeah, so it is not valid because we mentioned that if it's a descending trend channel or trend line, the touch has to be on the top and not on the bottom. Okay, so if we look at drawing valid channels, the valid channels are if there are at least 4 significant touches, 2 at the top and 2 at the bottom. Okay. Over here, this is an example of a descending trend channel. So it doesn't have to be consecutive like this or like this, but just as long as there are 2 touches. Okay, now let's look at the different indicators that you can use to identify the trend. Okay, so firstly is Ichimoku cloud. So breaking down the lines, It consists of several components, and it's basically composed of 5 lines or calculations, 2 of which comprise a cloud where the difference between the 2 lines is shaded in. The lines include a 9-period average, a 26-period average, an average of those 2 averages, a 52-period average, and a lagging closing price line. So the cloud is a key part of the indicator. Okay, so let's look at breaking down the lines. So basically, when the price is below the cloud, the trend is bearish, or the signal over here is bearish. When price is above the cloud, the trend is up, or the signal is bullish. Trend signals are strengthened if the cloud is moving in the same direction as the price. So for example, during an uptrend, the top of the cloud is moving upwards, or during a downtrend, the bottom of the cloud is moving down. Okay, so let's break down the different lines. Okay, we have the Tenkan-sen or conversion line, and this is the average of the highest high and the lowest low over the past 9 periods. The Kijun-sen or baseline is the average of the highest high and lowest low over the past 26 periods. Chico's span or lagging span is the current closing price plotted 26 periods behind the current time. And Senko span A, or leading span A, is the average of the Tenkan-sen and Kijun-sen plotted 26 periods ahead of the current time, used as a leading indicator of the trend. Okay, Senko span B, or leading span B, is the average of the highest high and lowest low over the past 52 periods, plotted 26 periods ahead of the current time, used as a leading indicator of the trend. Okay, explaining the lines. So the first way to use Ichimoku is to identify trends. Basically, the Tenkan-sen and the Kijun-sen. Tenkan-sen is the one in blue, Kijun-sen is the one in red. Those are used to identify the trend of the market. So a bullish trend occurs when the Tenkan-sen is above the Kijun-sen, and a bearish trend occurs when the Tenkan-sen is below the Kijun-sen. Okay, you can also use your Ichimoku indicator to determine support and resistance levels. Okay, now the third way to use Ichimoku is for confirmation. So the Chico span is used to confirm the signals that's generated by the other lines, and if the Chico span is above the current price, it confirms a bullish trend. If the Chico span is below, then it confirms a bearish trend. Okay? So Ichimoku generates buy and sell signals based on positions of the various components. So for example, a buy signal is generated when the Tenkan-sen crosses above the Kijun-sen and Senko span. And a sell signal is generated when the Tenkan-sen crosses below the Kijun-sen. Okay, so how can you effectively use this indicator? So basically, the overall trend is up when the price is above the cloud and down when the price is below the cloud. Yep, and trendless or transitioning when the price is within the cloud. Okay, so of course you can also use support and resistance, as we mentioned earlier. So yeah, so you can see when price is moving below the cloud, it is bearish. When price is moving above the cloud, then it's bullish. Within the cloud is typically transitioning. Okay, another way is price and MA cross. So if you're a beginner, this is a great way to identify moving averages of different periods to analyze price movements and generate buy or sell signals. I won't get into it, but yeah, this strategy basically captures trends and works best in trending markets. Next, we have the golden death cross, which is a strategy based on the intersection of two important moving averages on a price chart. Okay, so I'm not going to explain how the indicator works, but basically, when you see a golden cross, it's a bullish signal. When you see a death cross, then it's a bearish signal. Okay, channels as well. You can see when price hits the sides of the channel, that's typically a sign that price is reversing off of the channel. Okay, so when you are deciding which settings to use for your moving averages, try and make sure that it touches the bottom of the bottom or the top of the price as much as possible. Same for natural moving averages. And a double break is basically when price breaks below the moving average as well as your trend channel. So basically, as I mentioned earlier, when you have an analysis, you want to try and make sure that you use different indicators to support that analysis. Okay? Yep, so that's what we call confluence. You can see in this case, we are using a trend channel, Ichimoku, as well as moving average, as well as your death cross. Okay, you can see we see this price moving upwards. Okay, so to wrap things up, we'll quickly go through the disadvantages of trend trading. So basically, it can give you false signals, late entries, some choppiness as well, whipsaw trades, which basically means that traders enter and exit positions quickly due to volatile price movements, which can result in losses. Limited profits in ranging markets, and it might require timely decision making. And lastly, noisy price data. So to overcome it, you want to make sure that you have all of these in check. And how you can make sure these are in check is by basically making sure that you use a trading journal so that you can track your trades, track your strategies to see what works and what doesn't. Okay, and this is just to show you guys what an unclear market structure looks like on a 15-minute time frame. You can see it's pretty messy. There's no clear price movements. But when we change to 1 hour, you can see it's pretty clear. Okay, so yeah, so this is just a kind of a rule of thumb to live by. So if the clearer the swing low, the clearer the swing high, the clearer the trend between these 2 points, the more accurate your analysis will be. Okay, that brings us to the end of my slides. Thank you guys so much for joining me today. I hope you guys found this helpful. And yeah, have a great rest of your week, and I'll see you guys next week. Bye, everyone. Thanks, everyone. Bye.